Recording progress.
Hey Danny, this is Marco Payadas, American Retiree Club, Roth conversion experts. And we spoke last week regarding some Roth conversion options that you were interested in seeing. And then we could not connect on Zoom for whatever reason. It could have been the Zoom issue that day. So what I'm deciding to do, I'm going to record this video and send it out to you for you to review at your own leisure. So let's go ahead and get started. So step one here is I'm going to go over this presentation and hopefully you can see it full screen on your end. And it talks about Roth conversion strategies, how to eliminate the IRS from your IRA and 401k. Okay, so this is what I was going to cover with you. If you could minimize or even eliminate your taxes, would you? Most people we talk to say yes if they're looking to do a Roth conversion. So I'm assuming you're saying yes to this. And one of the main reasons why is federal income taxes are going to be increasing in the year 2026. So that's state income tax, Social Security taxes, IRMA, which is Medicare, and federal estate taxes are going to be increasing in 2026. Our current tax breaks are expiring at the end of 2025. Another reason is our national debt is almost $34 trillion. And I think by the time you get this video, it would have hit 34 trillion and growing every single day. Okay. Now, another silly question. How long do you think it would take to count to $30 trillion one by one? So in that case, it's 960,000 years to count to 30 trillion. The reason we ask that is because they talk about this number every day on the news like it's a regular number, but it's the most debt we've ever accumulated in the history of the United States if you were to add it all up. So it's an astronomical number, and this is one of the main reasons that tax is going to be increasing. Okay, now here's another number, 36.7 trillion. This is how much money is in current US retirement accounts, which includes IRAs, 401ks, 403bs, 457 plans, and thrift savings plans. And this is based as of last year. So the $34 trillion question is this. Where do you think the IRS is going to get the money to pay for all this? And the answer is this. You, me, you, and every other taxpayer in the US. Okay, so this is why we're preparing. So current tax breaks are expiring, okay, and in 2026, here are the projected tax rates. So right now, based on your current income, if you're between 0 to 22,000, you're paying 10%. That's not going to increase. Where it is going to start to increase is in every other income level. 22 to 89,000, it's going to go from 12 to 15, a 3% increase. 89,000 to 180, it's going to go from 22 to 25, another 3% increase. Between 180 to 190, going to go from 22 to 28, which is a 6% increase. So depending on your income level, every level is pretty much going to increase until you get to the over 490 range, which will stay at 39.9% for these three levels from 35 to 39, 35 to 39, and 37 to 39. So depending what income tax bracket you're at joint, and this is married couples, there's going to be an increase no matter what. Okay. Another thing that's come up, it's called the widow's tax trap. After you have passed, your spouse will inherit your qualified plan. She'll inherit your IRA. So, what could go wrong? Well, now, just as an example, if you're filing married and joint, and let's just say you're in the 12% tax bracket, meaning that you're receiving at least $94,000 a year in joint income, overnight, you're going to jump to the 22% tax bracket. That's a 10% hike at a very tough time. Okay. So the difference is, as you can see here, married and joint is between 94,000 to 201, whereas single, it's 47,000 to 100. If you look at that, it's almost $100,000 difference, which is astronomical. Okay. And this is very difficult if you're a surviving spouse. And if there's a loss of income due to death, loss of income due to Social Security's payments going down, and so on and so forth. Now, another change, and this one already happened. This happened in 2019, which is called the non-spousal inherited IRAs. So if a non-spouse inherits your IRA or 401k plan, what happens before 2019, they could extend that IRA, meaning that they will only be required to take the required minimum distribution, which in case created a multi-generational IRA. Well, that changed. Now Beneficiaries that are non-spouse only have two choices. They can either take a lump sum payment or take distributions of the IRA over a 10-year period. So the generational IRA has ended as of 2019. So our Roth conversion strategy helps to cover some of those tax issues. Okay, and this is what I'm going to go with you today. Here is an example of someone with a $500,000 IRA or 401k plan. Now, depending on your state, their state approved plans, they have what's called internal Roth conversion measures that create that Roth conversion by itself. So here it is. Depending on your state, in this example, we're using a 16% state approved bonus, which brings an additional $80,000 to the original IRA to make it $580,000 on day one. Okay. So what happens is the interest that it's earning, we're assuming it only earned 5%. So we're being really conservative. And the person's in the 24% tax bracket. So what we're going to do, we're going to convert roughly 132,000 per year. 31,000 year one, year two, year three, year four, and year five are going to be paid out to the IRS for the Roth conversion. At the same time, 99,000 is going to be going into that Roth conversion account for 5 consecutive years. What that does, it allows you to defer some of those taxes for 5 years, so you're not paying them all at once. Okay, so with this bonus and the interest earned, we're going to turn 500,000 taxable dollars to 500,000 tax-free dollars, and those tax-free dollars also earn interest. Now, the interest is coming from the state-approved accounts. Okay, so the total tax paid using other people's money is $156,000. That's how we're able to keep that 500,000 401k or IRA intact and not reduce it by having to pay taxes out of the initial premium. And once we do the calculation, the internal rate of return after everything has been calculated and deducted is about 7.7%. So you turn your 500,000 of taxable dollars into 500,000 tax-free dollars. And that's what we call a tax-free happy land. Okay. So here's an example that we did for $1 million. Initial premium, 1 million. And we did, assuming we were only earning 5%. Here, the account state approved bonus is 16%, which gives you an additional 160,000. We're predicting that it's a 24% tax bracket. This will have to be customized by each person's tax bracket. Annual fee is 0.95%, under 1% in the state of California for a 68-year-old. Now, once this account is established, now we have the starting features. So instead of 1 million, we're starting at 1.160. Now, this particular example is based on a 5-year conversion. We can customize that based on what you think works better for you, whether it's 3 years, 5 years, or longer. So once we convert 260, the company is going to hold out 62,000 for taxes. 62,546 are going to be held out. Just like you withhold taxes from a paycheck for taxes at the end of the year, it does the exact same thing. It's called an internal Roth conversion. Now, by doing this over a 5-year cycle, okay, the remainder of the original transfer, which is 260 minus the 62,000, gives us 198. 198 is done converting over a 5-year period. But what also happens is this: you take the initial principal plus interest earned. Interest is added to the traditional IRA, and then interest is added to each Roth bucket while the conversion is being done over that 5-year period. So at the end of 5 years, what happens? We turned $1 million of taxable dollars into 1,072,000 tax-free dollars. Now, after this 5-year mark, it continues to earn interest based on the account performance. So over that 5-year period, we've used other people's money to pay for those taxes, which equals 312. And when interest is added and even the fee is being deducted each year, the internal rate of return, once everything is calculated, is 7.51%, 7.5% on a Roth conversion, while not having to use your own principal. Now, these accounts vary from state to state, so depending on how much you want to convert, we can customize this based on your specific goals and needs. Okay. So if you look at this, if you just keep earning that minimum percent, by the 10-year mark, you've turned it into 1.3. This is an example of an internal Roth conversion with a state-approved bonus and interest earned while still protecting your assets. Okay, there's no downside. The market upside varies. It could be as little as 3%, as high as 10, because it's not invested in stocks or mutual funds. They can lose value. So hopefully that gives you enough information to get started. I'm going to send you this by email and also attach my phone number, which you can call or text, and hopefully we can talk this week sometime to customize this plan for you. So thank you for your time today and hope to talk to you soon. Take care.